level of personal service to the county that the warehouse change just can't match.
Well, we are.
Hi guys, how you doing?
Can you hear us?
Yes.
Okay. We're
Can
doing
you-
well.
Why is this? How you doing?
Doing well.
Hold on a second. There's
Technical difficulties.
very interesting.
Kenneth Road, born and raised. Spent my whole life.
Very strange. Hold on a second, guys, because something else is playing. And here we go. This. All right, can you hear me?
Yes, we can hear you.
I think he's talking to somebody else.
Oh,
Say something?
hello?
Testing, testing. Okay. Can you guys hear me?
We can hear
We
you.
can hear you.
Perfect. There we go. Okay.
So you can hear us, obviously.
My Bluetooth got connected to the phone, then I turned that off and it connected to the phone, and then the video that was playing on my phone decided to play on the computer, and it got all they got all
I hate
mixed
that.
up.
Yeah, sometimes technology can get in the way of success.
Absolutely, for sure. How you guys doing?
Doing
All
well.
right,
How's your week been?
So far, so good.
busy.
Yeah, I was up at 4 o'clock this morning golfing.
Yeah, that
Oh,
was
wow.
real busy.
Yeah, it is busy
Yeah,
for
yeah.
some of us.
That's great. 4 o'clock
Yeah.
golfing. Wow.
Got off the golf course by 8:30 this morning, had 18 holes played with my son, and life was good.
That's great.
Yep. So,
That's
Yeah.
fun.
yeah.
You guys
Daniel coming in.
about underwriting?
I'm sorry, what?
You guys going to talk a little bit about underwriting today?
Yeah, we're ready.
Sure.
If you want to see something that's impressive, I'd like to show you the first phase of the project we did out in Kansas City.
Yeah, absolutely.
Yeah, how many tabs do you have on that Excel file?
Well, too many to count. That was what, 169 million dollars here.
That was the first
No,
one.
no, what I do is hi, that's Nathan, right? Hi, Nathan, how are you?
No, it's
That's
Daniel.
Daniel.
Oh, wait a minute. That's
No,
Matt.
it
Oh,
says
hold on.
Natalie Lowry.
Hold on, that's my
Is that
wife.
Daniel?
That's his
That's
wife.
me.
Okay.
Hello.
Whatever name you go with. I'm
Hey,
done
I
with the
identify
way.
with Natalie.
Karen.
And this is my better half, Karen.
Okay.
And I'm one
Nice
of
to
those
meet
guys
you
that
guys.
believe that happy life, happy wife,
No,
Yeah.
happy life. We
whatever
got
it
the
is.
wrong way.
Yeah.
That's why we gotta be patient.
But in terms of underwriting, we look at it 3 ways, really. One is I'm an Excel guru, and a lot of the stuff requires a lot of modification. So I have a base template that I've used in the past for smaller underwritings. And then I have one for huge underwritings like this Kansas City project. And we've also used the Daniel Blank,
Michael Blank.
Michael Blank. If
Yeah.
you're doing, stuff that's pretty plain vanilla,
Mm-hmm.
that kind of cuts it. But some of these deals that can be rather unique. And the one thing that I don't necessarily like about LeBlanc is the fact that, to me, when you do the underwriting, and I've done about 500 or 600 of them in the last 10, 12 years, the noise is always in the rent roll. I spend a lot of time and I do a lot of analytics on the rent rolls. How many years have people been in? I mean, we've done some where there's been 500 and 600 units in there, really, 50, 75, $100 million projects. So I want to really dig into the rent roll. So I have ones that are specifically designated for that. I also have ones that we do all kinds of calculations when there's a lot of value add. We do all kinds of financial statistics in there. And like I have an inversion table. I actually have one that does present value calculations in terms of the hold period, how long you want to be able to hold it, both from an interest bearing and a non-interest bearing, what I call leveraged and unleveraged. So there's all kinds of analytics, and maybe I'm boring you to death, but I'm a finance guy. And
That's
these are
all.
kind of the things that we do, but I just.
They
wanna-
love spreadsheets.
I do love spreadsheets. But I'm not trying to impress anybody. I'm not trying to blow anybody away, but I want to show you this one because this is perhaps my pinnacle of my underwriting skills.
This was a deal that was in an opportunity zone, and what they wanted to do was ground up. And it was for a hotel, retail, apartments, parking garage, pads. I can't remember what else it was, but it was all one big project.
Yeah,
Unfortunately, it didn't come to fruition, even though we spent a long time.
over a year doing
Yeah.
it.
But it was good because of the fact that we had to get various financing. We got financing from grants,
Yeah,
from tax exemptions, et cetera, et cetera. So we had
tax enabled, what they call TIF financing, which means that in a TIF grant, the state gives you money, the federal government gives you money, but it's under the premise you're going to hire people. And then also.
workforce housing.
And then there's also going to be like sales tax and use tax. So what, and again, this comes where my background is. I have a tax background where I actually take a look at those grants and figure out, you know, with the operations people that are going to be running the program, how many people are going to need to run the hotel, the parking lots and all that. And then we figure out what the inflation factors are going to be, what the revenues down the line. This even had a hotel that was going to be built on that. So they actually had a hotel tax. We had to figure out all that in there. So this one here, oh, this is really full. So this was all inclusive in here. And what a lot of times what I also do is I like having dashboards in the front, because the last thing you want to be able to do is show an investor. You're not trying to impress them with the spreadsheet. It's all about the numbers, right? So they want a quick snapshot in terms of what are you looking for, you know? And can you share this with me?
Sure. Let me
And
see.
I'll show you what I got here. Now, the other thing we got to tell you is that this is proprietary. If you share it with anybody, we got to shoot you. No, only a joke, only a joke. But this spreadsheet was built specifically
Can
for
I
this
see it?
project. And
Oh, we
this
can't see
took-
it.
This took
Okay.
over a year to put together.
Wait, wait.
Go
Can
ahead.
you see it?
Yeah, you can share your screen.
Let's see. How do I share on this one?
Down below it, there's a little green arrow that says share.
Oh, yeah, right.
Oh, yeah. Share screen. There we go. Okay. All right. Right there is what I want. Share. Okay. Can you see this one that says sources and uses?
Yes.
Okay. All right. This was what was called the South Point project, which was a drug infested area that the state, federal, county, and municipal governments all came together and said, let's get an investor, which we had, and let's put it all together. And what was unique for me on this project was the opportunity zone laws just came into being. It was brand spanking new. And the other thing is we actually used crowdfunding on this. There was a guy that we hooked up with. His name is Joel Block. You can Google his name. He's the guy that practically invented it. He went to Congress and helped sell the deal. Really, really smart guy. And it's where people can put $5 in and $10 in, and they pool all this money together. And the big concern at the time was, how's the SEC going to handle that? They're going to handle that as 10,000 investors as one. And they finally ruled that we'll treat it as one. You have one company that comes in and organizes all of that. But from our perspective, from a lender, we can treat it as one. You can raise huge amounts of money from small people, which is really, really nice. And Joel Block is, like I said, the leading guru. So we had all kinds of things that was really in here. So you can see the HUD financing that we got. We got a commercial mortgage, government bonds and all that. And when you do a deal like this, you want to be able to see what the sources and the uses are so people know what's involved and where the money is going to go. So that's the first snapshot that we have in here. And then this one had all kinds of property that were involved in this as well. Mixed use, shopping malls, parking lots. And this basically gives you what the total square foot of this whole thing is, how many parking lots there were. And remember, this is only the first phase of 3.
Was it 3?
It was 3 phases. The total was about 376 million. All right. So you can see the parking lots, everything that's involved in there, where the equity came from, the funding from construction. There was going to be commissions paid, which is basically for Joel Block. Joe Block, who was the guy to put the whole deal together. He basically, it was $100,000 in legal expenses we spent, $100,000 we paid him, you know, the marketing cost, the attorney's fees, you know, what we got some of it out of here and other fees, and then the equity raise. The project funding summary, you can see here where the overall project, where the units and the square footage was, the HUD, and when you're dealing with HUD, you better like paperwork, because there's a lot of paperwork that's got to be done to get a HUD loan through. Really, and we actually hooked up with an investor in Bedford, of all places in our town, that happens to be the facilitator of this, very wealthy gentleman, and he really helped us through the process, which was good to know. And we got to, you know, we never invested with him, but it was an opportunity that was there. And also a quick summary of what the stabilizer is going to be and what the return was going to be.
Doug,
And
is this a brand new construction that they were developing all the different sections of this?
that is
Or
correct,
was it
right?
The existing property that you were renovating and getting grants for the renovations.
Correct. What happened was, the bottom line is that there were older buildings here that were probably over 100 years old.
Mhm.
And it was so bad that the police would not go into this area. So with the help of all these different governments coming together, I mean, we had the FBI was involved in this thing, everything to clean everything out and push everything out of this area and make it a work lifestyle type property. And that's what this is all about. And believe me, the money's there. If you ever want to get involved in this thing, obviously we've got the contacts, but a lot of government money, you know, for those type of areas to renovate. It's out there. And again, we've got the experience, and we can help you with that. And then, you know, the other thing is that I also like to do is the weighted average cost of debt. Now, you got to remember, we put this project together, the interest rates in the 4 or 5% range. So obviously we got to take that into consideration, and don't let everybody tell you that there's no money in government. These private companies that manage all these funds, it's unbelievable how much money that you've got to pay for this thing. Take a look at this thing. FHA fees, $259,000. 543 for lender's fee, other carrying costs, legal organization. You have to get audited, and you have the privilege. They're going to audit you. You have the privilege of paying for it. It's insane how these things actually work, but it just to manage this whole process. And then what I also like to do, the way that I like to manage my spreadsheets, is that I like an input page. What I do is I link all these files with the head screens. I don't want to sit there and say, you know, I got to change the square footage, so I got to go find where that tab is. I have everything all linked from the very beginning. So I can make any number of changes and assumption changes, and bang, it's all simultaneous. And that's why my spreadsheets are very big. If you look in here, you can see how many tabs I have in here. There's probably 25, 30 tabs. Is the fact that you want to integrate it so that when you make one change, everything flows all the way through. The good and bad about that is if you got an error on a formula cell, sometimes it's a real beast to find them. But you know, I'm pretty good at it and can manage that process. So these are all the inputs that go into all the different spreadsheets.
So you have one input page that.
I'm sorry, what?
You have one input page.
That is correct. Yes. Yes. It's the only way to manage it. Only way. And the thing is, when you put a big spreadsheet like this together, is the most important thing is organization. You got to know where the information is. And if you don't have it in one spot, we can easily get to it. It's a bear trying to find something to go to change it, or someone, you break a formula and you got to go back and you got to find it. Well, when you have this, you know where to go for it. Now, there's some tricks in Excel that are pretty advanced. If you have problems, you can do that. There's some keyboards that will actually trace them through at some point every once, so I can show you how to do that. But anyway. And then I have the tax references and everything that goes all the way through. And you can see it's pretty extensive.
This is not your ordinary multifamily.
Yeah, but this is everything. And in the bottom line, if you can do this, I mean, to do a $3 and $4 and $5 million for me, I mean, that's a walk in the park. All right. Now, in a project like this, and Nizan, you probably know this as well, is that the timing of the money is important.
Sure.
So one of the things that I spend a lot of time on is figuring out when the draws are going to be necessary. We spend a lot of time with the general contractors, figuring out the timing of the money. And then also that lends the total cumulative cost of the project, the weighted average cost of the debt is dedicated on when you do the draws. So we end up doing all that in, so you can see what the percentage of the draw is. And by the time we got to, it was 33 months start to finish if we hit the project schedule, that we would have spent 100% of the money. So basically, for the bottom line, from the time you break ground, it was 3 years to finish this project. And then I just show it graphically, what's in there. Then what happens is, now what you've got to do is, you've got to take, again, working with the contractors, is figuring out what everything goes into the bucket, how that cost is allocated. Now, there's soft costs, there's hard costs, and there's other costs. The hard cost is the physical building materials, that kind of stuff. The soft costs are the programming, the management fees, all that, and the other costs are the miscellaneous. And in a project like this, there's a lot of contingency in here. Later on, I'll show you the detail, but you'll go in there and you'll see a lot of contingency, and you got to have it in there, and it's built in. And I will tell you from my experience and the manufacturing side, I used to build $1 million furnaces for certain industries and universities. You use those contingencies because at the end of the day, everything's an estimate. And if you don't build decent contingencies in there, then you're going to have cost overruns, and you got to make sure from your financing and your funding that it's solid.
Doug, let me ask you this. Maybe we can do this. This is quite the extensive
It is.
spreadsheet. I don't think anyone on this call here is ready to
enough.
go into something this size and nature.
no.
What my coaching clients here are right now, a lot of them are getting into multifamily. A lot of them are doing, anywhere from the 4 to 100 unit properties. Your C's, your bread and butter, C value add. I know Natalie and Daniel are actually working on there's a developer in South Florida that's developing a 16 unit property across the street. He developed another 21 unit property, and they're looking at that types of assets. And there's a bunch of people on the call right now that are getting started in multifamily that are going after the quads, the 10 units, and so forth. Can you share with them best underwriting practices, what they should look for, rent rolls, what to look in a rent roll, how to analyze the rent roll? Because when you said the rent roll is the key to success, right?
It is.
Understanding the rent roll.
No, I know exactly. No, this one isn't completed in terms of information on it, but this here, I'm going to share this now. This is my standard that I built that kind of competes with the Michael Blank type template. And this is what I use for the basic underwriting for a multifamily. All right. So the first thing that I have in here is I don't want to spend a lot of time on underwriting that isn't going to work for me. So the first thing I have is I have what I call a minimum criteria underwriting. I look for these 8 criteria, and I've got to hit 6 or 8 of them. And if I see any red flags in here, I'll sit down. Do I want to spend 20 minutes doing this thing? Do I want to spend a whole day? And on some of these properties, you can spend a whole day just on a rent roll.
Sure.
So this is the.
What are some flags? What are some flags? We don't see your screen if you're sharing.
Oh, I'm sorry. I thought I was sharing. Okay, my bad. Okay. That's it right there, right? Yeah. Can you see?
It's kind of like Dave.
Yeah. Can you see this where it says minimum criteria underwriting?
Right.
Okay. First of all,
can you enlarge that a little bit? The print is a little small.
Print larger.
Oh yeah. My bad.
Thank you. Appreciate it.
How's that?
Perfect. Thank you.
Okay. What I'm looking for is the age of the building. I don't want to go, beyond a certain age, right? The unit mix. What we try and do is we want to have the smallest number of 1 bedrooms in there. We primarily want to look for things that have 2, and 3 bedrooms and, 1 and 2 baths. When you have a lot of 1 bedrooms, our experience is you have a lot of turnover. Right. So you try and avoid a lot of 30, 40, 50% 1 bedroom. All right. That's a non-starter for us. We're looking for bedroom sizes. We want to have a 1 bedroom, at least 660 square feet, 2 bedroom and 3 front. And so these are the things that we look for in the rent roll. The roof type, If it's a flat roof and it's a membrane, depending on where you're on the country, if it's more than 5 or 6 years old, that's something we got to take a look at, in terms of the underwriting and determine, if it's 10, 12 years old, more likely than not, you're going to replace the roof on the building, right? So that's what we look at, the age of the roof. The HVAC system, are the individual compressors, are they within the whole building? How old are they? When have they last been serviced? Those are the type of things that we try and drill down and ask, the brokers and that kind of stuff and get the information for. We have the Dave Lindahl indicator, RE indicator.
Mhm.
So what we're looking for is, we're looking primarily for B and C properties. We try and avoid the Ds and, all sub S and those kinds, not sub S. What do you call that? Chapter, people that have government.
Oh, section.
Section 8. Yeah. They're good. We try and avoid, I personally, I'm not a big fan of it.
Some people like it.
Some
so
people
I don't
like
know how
it.
they
It's,
feel about
yeah,
that.
we necessarily shy away from that. We're also looking for individual metering. Are they each one individually? Is it the building, whatever? Because then you have to have a RUBS program and those type of things. So we're also looking for that. And the minimum occupancy is the fact that we're looking for at least 85%. No, one of the things that I look in the rent rolls and what I ask of the realtors is, I usually, if I can get, I want a 2 or 3 year rent roll, if they'll provide it. And the reason I want that is the fact that I buy and sell companies, big company. I sold a big company at Owens Corning. All right. What they're looking for is, I know how to dress up a business prior to the sale, make it look good, right? If you can get financials and rent roll from 2 or 3 years ago, you can see really, what kind of maintenance they were putting into the building. And for instance, one of the key indicators is when someone's getting ready to do a building, all of a sudden they get a lot of CapEx spend. So, normally what they do is they expense it off. So they're trying to drive down the NOI. But when they're trying to get ready for sale, normally if they plan it out, it's a 2 or 3 year process. They start putting everything in CapEx. CapEx takes it out of the income statement and it drives up the NOI. When you drive up the NOI with a low cap rate, you get a high sales price. Right?
Mhm.
So that's what I look for in terms of that. I want a 2 or 3 year rent roll if I can get it. And I want P&Ls for 3 years.
Is there anything else, Nissan, you think we can add to
Yeah.
that?
Anything else you want to add in there?
That you guys are,
You
No,
look for?
you guys are doing great. Absolutely. I mean, this is the criteria that we're looking for as well. You're spot on with the unit sizes, with the roofs, the location, the neighborhoods, B's and C's, preferably in an A neighborhood or even in a B neighborhood.
yeah.
I've done Section 8 before. While I love it that the income comes in on the 1st and the 15th of the month, but if you don't budget for high repairs and maintenance,
Yeah.
that could bankrupt you.
Oh, yes. Yes.
They don't, Section 8 tenants don't care for the property. It's
No,
not in their mentality,
And they keep their beat up cars in the driveway, and
Yeah.
it looks lousy. And
Exactly.
now likelihood the landlords haven't taken care of the property, the fences are all beat up,
Right.
we just don't want to deal with that.
And I agree with you. And we have 2 questions, and I'm just going to say this. I agree with you on the past financials and rent roll. From experience, I've gone into properties where we bought them and suddenly the occupancy jumped in the last 3 months
Yeah.
before
Yeah.
ownership.
It's
And
amazing.
you go, wow, occupancy is great, but what we don't realize is once we bought the property, those new tenants
paying.
after 2 or 3 months stopped paying.
Okay.
Yeah. Yeah.
Because all they did was put heads in bed. So having that historical view is huge to understand the actual, what the performance of the asset was and how the previous
Mhm.
management performed.
Mhm.
But let's go to Levy real quick. He's got a question, Levy, if you want, and then we'll go to the chat. We have some questions. Go ahead, man. Unmute yourself.
Thank you very much. I appreciate your time. Quick question. Once I requested the 2-3 years rent roll, everything, how do I verify that the data was provided actually accurate data and not, something that looks good on the paper?
You want us to answer that?
Go ahead.
Oh, no, well, this comes down to the integrity of the broker, right?
Property manager.
And the property management, right? And if they're willing to lie about that, then I don't want to be any part of the deal. This comes down to the reputation and knowing who you're doing business with, which is very important. Now, we check out brokers. We make sure that we're comfortable with them. And it's more than just showing up one day and saying, I want to buy your property. It's a relationship that, you know, hopefully you get the off-market deals and those kinds. So it's a long-term building those reputations. And to me, when you build those relationships up, I would think that the broker that wants to sell the property is going to be honest and forthright about it. And I will say this,
And he wants future business.
and they want future
So,
business. For the
that's the other
most
thing.
part, brokers are really good. They're not like real estate agents that you have for private
Gotcha.
homes and all that. These are, most part, these are high-powered guys. I mean, they really are, and they really know the business. And for the most part, I haven't had a lot of problems with brokers. We've had a few scumbags, you know, here and there. We walk away, we don't ever want to do business with them again. But it really comes down to integrity. It
And
really
the
does.
integrity of the property management. I mean, if somebody has, you know, this good property management company, they've got a good reputation, they've got recommendations and things of that sort. You've got a little bit more to go on than if you don't, you know, have these recommendations from other people.
Right.
Understood. Thank you.
Another thing that I would do, another thing that I would, you know, when you're getting the rent roll and the financials, you want to make sure that you want to get them certified by the seller. So that the seller now has to sign on it saying this is true to the best of their knowledge. And then on top of that, I ask for either tax returns or bank statements to corroborate the income that is going into the bank account.
Mhm.
Okay. Because, you know, a lot of times also, you know, some sellers, you know, they'll put a girlfriend, an ex-girlfriend, somebody else in a
Yeah.
unit, and they'll look at it and they'll be vacant, and then they'll cash, and then they'll take the cash, or they'll try and finagle things or whatnot. So you always want, you want to make sure that you can verify income from different angles as well.
Yeah.
Right.
And
So-
normally we do that. You do that during the due diligence. You do it during the wine and dining. Oh, normally that comes out in the due diligence. And I will
Right.
say this, I'm a tax CPA. If someone's willing to lie on a tax return, yeah, that's fraud. You go to jail for that. And that's why, particularly for the bigger properties, I want the tax returns.
That's right.
They're not
That's
going to lie. Trust me. There's no way. No one's going to jail for that.
And on top of that, let's say they do lie. Let's say you get a certified rent roll and certified financials, and let's say you get, you know, falsified tax returns, and they give it to you, and you close on the property, and then you find out that
You have
that
recourse.
all the information was false. Guess what you can do? You
Sue
can now
them.
go back and sue the crap out of them and get more money and get all kinds of stuff from them. So
Absolutely.
you want to, you know, that's, you know, CYA, right? Cover your ass, cover your assets, right?
Mhm.
That's how
Oh,
you
yeah.
cover yourself, right?
I
Excellent.
couldn't
Thank
have said
you.
it better.
Right.
Tax
We
returns.
have a question here from Natalie and Dan. Can you give us some tips on where we can get instructions on working and learning frequently used Excel spreadsheet formulas? Where's a good place to learn the formulas? Do you have a place?
There are a lot of things online. You have a particular person that you like.
Well, there's a woman online, and Nizan, I'll send it to you, okay?
Right.
She's a professor at a college, and she's on YouTube all the time, and she's phenomenal.
Great.
And some of them are only 2 and 3 minute videos, and some of them are 8, 10, 15 minute. Can you make a note of that?
Yeah.
And this woman is really, really good. You know, I have an advantage over a lot of people. When I was in college, I used to be a COBOL programmer.
Oh, okay.
So Excel, and you know, you notice that this is a, if you look at, there's many types of Excel. There's Excel XS, which is a normal one. I actually write macros, which basically automate your spreadsheets, and you could all do fancy things and like that. You'll notice that this one is an Excel SM because I have macros written in this thing. But that's your highest level of Excel. I wouldn't expect most people to do that, but this woman is really, really good. And it's trial and error and understanding what the formulas do. That's the thing.
If you're looking for a course from beginning to end, there's a place called Udemy, UDEMY. They've got a lot of good courses. I mean, I picked them up for like $9.99, some like, you know, Excel courses or whatever. So depending upon what you want, they might have like beginning to end and say, Excel or Excel, what do you call those? Your pivot tables or whatever the case may be. So
Right.
And you can pick them up real cheap.
And,
I
and the other
appreciate
thing is, like, when it comes to Excel, if you ever have any questions, I'm a resource. You know, but it's trial and error. And Nizan, you've got my email account. You can send it out, and if people have questions, I'd be more than willing to help them out with that. But it's trial and error, and it's learning it, and going to the videos, and really sometimes even I have to go and look at the videos 4, 5, and 6 times, and then it finally dawns on me and how I really can learn it. But it really is trial and error.
Well, Douglas and Karen, I would love to work with you guys in regards to, because we're getting a lot of off-market deals.
Yeah.
A lot of some on market, but majority of them off market. And sometimes I find myself doing my best to doing my best to underwrite 2 or 3 at a time. So like
We
I
can
said,
do that.
I would love to work with you
Yeah,
guys.
I mean, those are easy, but the one thing, this is why I have this page right here. Sometimes, we've actually done multifamilies at a 10, 15, 20. They're basically handwritten, you know, those type of things. And those are really difficult to analyze. And sometimes you say, is it even worth, you know, the mess of going through this thing? But, you know, if a broker isn't willing to put something together that you can actually analyze in a nice property package and all that, that's probably the deal you don't want to get involved in.
Stay away.
Yeah, I mean, that would be my advice. You can do what you want, but that's my advice. If the broker can't even bother putting something decent together. And I've seen some, well, we've actually almost landed one in Jacksonville, Florida. It was a 24 unit, a doctor owned. They had an unbelievable, as good as I've ever seen in terms of underwriting. The broker did a phenomenal job putting that together.
Hate to tell you, but you're gonna find errors. We found so many errors in brokers' numbers. So being.
Well, that happened to us today.
Yeah.
Excuse me?
Not today. Yesterday, right, Merlin? We were on a call with a broker. They had a rent roll for a 32 unit, but it turned out there was how many units, Merlin? It was like I think it was like 16.
And
Yeah.
I will tell you, and I'm going to show you in a minute, I have 2 tabs totally dedicated to rent roll. And this is where I spend all my time on. And I have found so many errors, like they'll put in their underwriting, they'll put together and they'll say, oh, this is the average rent, you know, whatever. You go through the actual numbers. I said, now, how do they come up with that number? And then you got to get on the phone and say, what did you do? And how did you come up with that? Because this is the rent roll you forwarded me. And if you can see this page right here.
I don't think this is
It was
sharing.
very robust.
Oh, did it flip over to the rent roll now? Can you see the rent
Yes,
roll?
that's the rent unit mix.
Yeah, right. So basically what this, I try and capture about every type of bedroom type unit you have in here, what they use their code. And then again, this is why I customize it, because every underwriting, they have a different name, a different category, and how they do this. You got to be flexible enough to be able to manage it. And then, you know, I'm assuming that everybody knows the difference between gross potential rent and actual rent. The gross potential is what the market is. And then you do your loss to lease and all those calculations. You got to be, and this calculates all this for you all the way across. So you know what your loss to lease is. So you know that if you raise rents basically at what they're telling you, then that's your upside when you buy the property. I find the hardest thing to do is to validate that. I mean, sometimes it's very tough. And when you're in a big city and you have a lot of comparables, and I don't know if I have it on this one, but I actually have one Excel spreadsheet. I actually go through and I put 8 or 10 properties and compare them so that I can actually see this is what's 2 blocks down the street. And Karen actually goes on the computer and says, this one's 3 blocks away, this one's 2 blocks away. And we go through and see if what they're actually saying is true.
So their comparables are not exactly great. Let's put it that way. You've got to do your own homework too.
Exactly.
And you're buying the property. This is where your time comes in. And this is what I'm saying. And I like that minimum criteria. You're going to spend a lot of time on this, and you're going to sit there. You're going to spend 10, 15 hours on a decent underwriting. Make sure that it meets your minimum criteria, because otherwise you're just spinning your wheels.
I'm sorry, Douglas. How many hours on an underwriting?
I've spent 10, 14, 20 hours.
There you go.
Well, it depends upon the size.
The size.
And the complexity.
You're talking a 200 unit going through 2-3 years with the rent rolls.
Yeah. Well,
And
I'm
sometimes-
not that deep.
And one of the things that I insist on, a lot of times they give it to you in PDF. Well, why do I want to spend inputting 200 units? I want Excel. You got to send me the Excel files.
Right.
If you ask, they'll give it to you.
Yeah, I learned that from Nizan.
Merlin has a question. She's asking, what criteria should we look for when it's a new construction, when it's not built yet? And they want to underwrite it.
and you want to underwrite it, the
It
most,
would be-
well, there's, what I would look at is, go to contractors and you want to know what your cost per square foot is. Then what you got, and get comparables and see if they're in the ballpark or not. The other thing you want to take a look at is what assumptions do they make on the revenue side? Is it reasonable to what's in the marketplace? You know, they're saying, oh, we can get $1,800 for this unit, you know, for a 1-bedroom brand new, and the market's at 1,600. Well, is that 16 market? Is it an A property? Is it a B property? Where is it
Well,
located?
it's new
No,
construction.
but if it's in a B area, you may not be
Yeah.
able to get the A price out of it.
The other thing is you want to go into that town or that city as well and find out what is going up. What are the other rents, you know, if there's new construction and stuff like that. What are they getting? Are they gonna be comparable to your new construction? So, you know, knowing what's the development is around you is also an indication of possibly what you might be getting for rents.
And then you gotta look at their assumptions is the fact that, what assumptions they have for the profit. What is the cost of the funds? You know, how much, you know, what do they think their average, to me, one of the calculations is the average weighted cost of debt to carry it. Is it reasonable to what's in the marketplace now? I mean, that's a financial calculation, but being a finance guy, I look at that. And the big thing is, what's the construction budget? Is it realistic? The cost per square foot? When they throw up the building?
Right.
That's
so
what
we
I
were
look at.
We were looking at, there's a property I mentioned, there's a 16-unit property, and across the street, the same developer built a 21-unit property. He
I think
has,
it's 100,
No, it's like
Yeah.
92 units.
how much?
Yeah.
92.
He
Oh,
sold
92.
a 21 unit in the same town, but right next door is like a 92 unit.
Mhm.
Right,
Same
but the
builder.
21 But the 21 unit was the
It's on the street.
277,000 a door,
Mhm.
right?
Mhm.
Yeah.
Right, so that, and what year was that built, the 21 unit?
Oh, it was just finished
It
right.
finished
it
this
just
year.
finished.
So it's finished,
Okay,
so,
okay.
so there's a
The
comp,
occupancy.
there's a comp from the same developer, 21 units, he's under contract for 277,000 a door. And the one that these guys are looking at, 16 units, is $266,000 a door from the same developer.
4 million, yeah, $4 million.
$4 million, and the rents are, what were the rents that
So right, and the developer put just new ones that 92 units next door. And the 2-bedroom, 1-bath are going for 2,400, and our 2 beds, 2 bath are gonna be 2,400. So
And
that's
it's
like-
Same quality,
But the other thing is, remember, it's just
quality.
not the rents, it's the square foot of the unit as well.
Yeah.
That's the other
Yeah.
thing you gotta make sure of,
right?
you know, it's the cost per square foot.
Mhm. So-
Right,
Yeah,
so
they're
the-
very
so the
similar.
90
Yeah,
almost- But they
okay,
have a second bathroom. Ours will have a second bath, 2 bath.
well, you can get more.
yeah, bathrooms draw more rent.
So yeah, the going rate for a 2-2 in that area is, I think, I want to say, if I remember correctly, it's 28. Don't quote me on it, but
Yeah.
2,800. Yeah,
Yeah.
There's already, I thought it was 24.
the 21 unit.
Oh, the 21
Yeah.
unit, yeah.
Because that's a similar one.
That's good comp.
Yeah, I would say
Really
can't get a
good
better
comp.
comp than that, particularly the same developer. The
Yeah.
designs are similar, same neighborhood.
Yes.
Yeah,
Looks
and no
good to me.
amenities, because I guess there's a lot of liability to put a pool and all that, so they just made them all
Simple.
yeah.
Yeah,
Mhm.
yeah, pools are nice, but I don't like the.
Is this being recorded, Nizan?
I hope so.
Yes.
Yes.
This is being recorded.
Oh, yeah, it says recording in the
Yeah.
corner.
And
Yeah, no,
I do
we-
have a tendency of speaking fast, so if I am, just let me know
Yeah, a lot.
and slow me down. All
They're
right,
very informative. I appreciate it, Douglas.
okay, no, fair enough. But here is where the rent roll is where I'm gonna spend my time. And what I do, basically, what this does here, I put, and again, I get in Excel. But there's also, if you know how to do it, there's a PDF converter. They do give it to you in PDF. You can convert it to Excel.
Okay,
Sometimes
wow.
it doesn't come in clean.
Yeah.
But what I want to be able to do is I want to be able to put in all of, other deposits, other concessions, the lease, where's it run, where does it start? Any additional monthly charges in there, I dump it because, you know, as you know, they have dogs, they have, you know, they'll take your garbage out and all that kind of stuff. You factor that all in here.
And knowing when the lease from and to is really good when you're going to be doing value adds, because gonna know how many units you can turn over per quarter, per half a
Right.
year, whatever. So then your budget has to go accordingly.
You're stealing my thunder to the next tab.
Sorry.
But hold on, I want to touch on that real quick, because when you're doing a small property, 16 unit, it's not so difficult. But when you're getting into the 50s, 60s, and 100s, right?
Yes.
You have to then kind of, because not every tenant is going to vacate. They're going to want to renew. So how do you go about looking at the rent roll and saying, all right, there's 100 tenants, 17 of them are going to expire in the next 3 months. How many of those are going to renew versus how many are going to vacate? And how would you go about working or coming up with some rules of thumb for that concept?
Well, what I do is the first thing is take a snapshot what the actual population is, right? And I've actually had properties, we've looked at B and C properties, primarily C's, where people were there 12 and 15 years. They're not going anywhere. And what this table does is this tells us exactly the number of units you have that the tenant's been there, has a 1-year lease, 2-year lease, 3-year lease, because what we insist on, that lease from is when they first there. It's not, well, I renewed my lease, so I'm going from January of 2024 to December of 2024. No. We want to know when that tenant started, December of 2020. So we know that he falls in the 4-year category. And someone that's been there 3 or 4 years, and unless you have a big rent increase and you try and force them out, they're probably going to stay. And the problem when you have the value adds is you've got to be able to move people. You know, but you want, you know, turnover is expensive. You want to be able to keep those people, but when you're doing the value add, you've got to figure out how you're going to move these people back and forth, and you got to give them incentive for doing that. And then, you know, I have no problem in trying to force out a person that's been there 1 or 2 years and try and keep my guy that's been there 5, 6, and 7 years. Because more likely the guy that's been there 5 and 6 and 7 years, he's not going anywhere. He likes the property. He may have kids, may be retired, whatever it may be. They're on
That's
the
the
wrong
other thing.
criteria.
10 to 1, if they have kids or whatever, they're gonna be there for a little bit
Yeah.
longer than somebody who's single.
So what we do is we spend all this time. Now, what this spreadsheet does, this goes in and it feeds into the rent mix, and that gives me the gross potentials. And what this basically does, it certifies to me what they're telling you in your rent roll in terms of whether what they actually are showing is the average rent for this type of apartment, that type of apartment. It gives me my loss to lease. This gives me everything that I need to know. But again, when I'm evaluating the properties, this is where I'm spending my time. The rent roll to me is the most important thing. This is your revenue stream. You've got to really spend the time in there. Then what Karen was talking about, we've done a lot of underwriting where there's significant value adds. So when you do the value adds, there's multiple criteria that you want to be able to look at. Is it worth going in there? One, is it worth doing the renovations? So the renovations on themselves pay for themselves. And what we do here is I actually do this. We'll take the number of units, you know, the 1 bedroom, 2 bedroom, and 3 bedroom, and we actually figure out, we actually go through all the units, assuming we're going to do them all. We figure out how long it's going to take. Well, what is the construction company and the property management company, how many units they're going to turn over a month? How many units they're going to turn over a year? And we figure out through the rent roll how we're going to manage that all the way through the process. And we factor that in, because when you're doing the value add, remember, you're losing the rents. And you got to be able to
It's
figure
gonna
out.
cost you more too, to get rid of them or to.
Yeah,
put them
but that's all.
someplace else.
And remember, to keep your good ones, you want them. But at the same time, when you throw the other guys out, you're going to lose that rent. So you got to factor that all in. And this is my spreadsheet. Again, this is why this is an enhancement on the Michael Blank, because we do deal a lot of value adds, and we go through. We actually do the calculations. And again, what I do is I take a look at a couple of financial criteria. Is I do a payback. Does everybody know what a payback calculation is?
No, go ahead.
No,
Explain.
what you do is you say, this is how much it's going to cost me to do it. This is what I anticipate So I have $100,000 worth of cost. How long is it going to take me to recover that $100,000 or $50,000 cost over the number of months? This actually does the computation for you on both a discounted and a present value calculation. And so therefore, if you spend $100,000 to renovate, if you increase the rent by $100 for each unit, you have 100 units, how long is it going to take you to pay that back? Because
Right.
that goes to your, does everybody know what a reversion strategy is?
No,
No,
The reversion strategy is what is the, and again, I'll show you the math on that.
Oh, we don't have much time, that's what.
Are we limited on time or can people go over?
go ahead.
Okay. Part of
We're
the
all
whole thing,
ears.
when you're doing renovations, you've got to be cognizant of the reversion formula calculation. Reversion basically means when is the optimal time to sell the property? What you don't want to do is still be doing construction when it's time to sell the building.
Correct.
That has to be factored into your strategy. So basically what I do is there's a couple of things here. What's my payback? Is it going to take me through, if my reversion says that I should sell it in 6 years, if my renovations are going to take 5 years, I don't really have a stabilized property to sell, right? You don't have enough time. That's what you're looking for to do. And that's what the payback is telling me. My payback is going to be 3 years. My reversion says it's 6 years. I got 2 solid years of stabilization. And the third year I can increase rents, bang. I should have a solid exit strategy to sell the property on. Because that's what the name of the game is, right? The money's made when you can drive up your NOI and sell the property at the optimal time. And then a return on investment is basically the money I spent, the money I got in, and you end up doing an ROI. And if your ROI is less than 100, it's no good. You spent more money, you got no value out of it. It's not even worth doing the project. And then obviously the other one is just for the renovations, how much money I spent, how much I got back. You want to know what your cash on cash return is as well on that. And then this just does all the math for you.
Again, this is for the large units.
This is for your 100, 200, 300. We've
Yeah.
done 500 unit. We go in there for 3 years. We got a huge construction company going through there. And we just want to know, again, from the reversion point of view, is the construction going to take more time than we should be selling the property on? All right. What everybody also wants to know is partner distributions. This is your waterfall in terms of this is the team members. So normally when we do a property, you have your investors and you have your team members, right? So, there'd be 60, 40, 70, 30, whatever your splits are. So this is basically what Michael Blank and everybody else has all this thing. This is just your typical, how much equity do you put in, how much
Cash
equity you
flow.
get credit for it, your cash flow. And this also calculates your equity gain, your standard, what you're going to have in a multifamily.
Which is important to your investors.
To your investors and everybody else, a detailed debt schedule, like some of these properties can have 2 and 3 loans and whatever. But what I want to show you is, this is when I talk about a reversion strategy, this is what I'm talking about. This is a present value calculation that says, how long should I own this property? So you go through and you do your underwriting template. When everything is all said and done, you go do all of this thing. This is the actual underwriting template that we have. All right. It's kind of looks like the Dave Lindahl model. I have a few other things that
We added another.
we
column.
added some additional data in there, but it's a basic, this is what we have. This is what the trailing 12 months are. And this is what the pro forma are. I always like to compare. Whenever you're doing anything, I want to see how my numbers stack up against what the broker is doing. At the same time, I want to know TTM in my world means trailing 12 months. I want to know the trailing 12 months that the old saying is, if you want to know the future, you got to know your past, right? So if you can't at least get to what the trailing 12 months are, why even bother getting into the deal, right? If you can't drive profitability out of it, why waste your time? But that's what this template does. Pretty simple, pretty basic. But again, everything is all funnel through. And just like I said in my other big spreadsheet, I just want to show this real quick. Remember I told you I have one input page for everything on the entire spreadsheet? Here it is again. This is every single input that goes into this spreadsheet. manage it from here and makes it easy all the way. It just blows through the entire spreadsheet.
And most of this will go into a property package.
Yeah, yeah,
Not all
right.
of
So
it.
this is set up so that when you do your property package that you sell to investors,
Investor package.
everything funnels in pretty quick. So I just want to make sure that I covered that real quick. And
like that.
obviously, the actual underwriting on here, your cash flow distributions, the debt schedule is, because it's important to know what the debt schedule is and how much debt you have outstanding, because there's two things that you got to know. All right. One is your, again, I do this calculation. It's a pretty fancy present value calculation. This will tell you what the optimal period is from a leverage and an unleveraged. When I say leverage, people know what I'm talking about. Leverage means the cost of money is factored into the calculation. Unleveraged means it's dollar for dollar. Forget inflation, forget interest, all that kind of stuff. On a leverage calculation, you're going to hit it much quicker than an unleveraged, because it's not inflation adjusted, whatever. Just to make sure that people understand that this is a pretty fancy calculation, but to me, it's been proven pretty good. For the most part, if you buy a nice property, your optimal period should be 5 to 7 years. That's my historical averages. You don't want to go more than 7 years. The property starts getting older. You start running into more CapEx problems. You get diminishing returns on how much you can increase the rents because the properties are getting over. You may need another facelift. Less than 5, maybe too quick, because if you've done value added now, you've got all that debt. You probably had interest only for the first year or two. You haven't paid a lot of principal down. So that takes all of this into consideration when it does those calculations. All right. Then you're real simple, basic. This is your investor IRR for your people that you invest in this property. You know, what's your return? 16%, 18%. And this is going to tie in to this calculation as well. These are related, okay? This is in totality. It doesn't care about investors' money. This is the whole project. This is looking at it from the investor point of view. Why would an investor want to come into my property? You know, you've got to beat the average cost of money, the stock returns for people who invest. You've got to have a 12, 13, 14, whatever the criteria is. That's what this calculation. This is focused on the investor. This is focused on the entire property. How's the entire project doing? Again, this is my input. This feeds into my underwriting template. All this is the trailing. Remember, I have the trailing 12-month here into my underwriting template. Underwriting
Yes.
template right here, the trailing 12 months.
That's where it comes from.
This is automatically linked. All that data comes from here. I take their trailing 12-month spreadsheet and I drop it right here, and it automatically feeds into that spreadsheet. And I want to see it month to month. What I'm looking for in the trailing 12 months is what funky things, what you want to do theoretically, for the most part, expenses roll pretty even. What happens is in your further out months, in month 1 or 2, when you're looking at the trailing 12, the expenses kind of have a tendency of going down because they may be doing some funky things, maybe they're deferring. They're trying to drive up the NOI.
Right.
And that's what you're looking for. And I have every expense category in here. I want to go through and I want to detail that out. And then I want to compare that to the trailing 12 months of the preceding year. I'm looking for inconsistencies. And then I'm going to come back to the broker and say, you know, what happened here? Oh, we painted cabinets. Oh, we replaced a lot of refrigerators, or whatever the criteria may be. That's what we're looking for. Consistencies. And then this is the reversion strategy. Reversion is the exit strategy. And again, all this is linked. Everything that you put in my input tabs, this is automatically going to feed. And what's going to happen is you put in your exit scenarios right here, which is all linked into my input page. You can see everything is linked. All right. And then this, and again, when you add 2 plus 2, you know, it's the same thing as 1 plus 3. Well, no matter how you do it, I like to do a proof, just the way I like to look at it. I actually do 2 calculations. I do one from the sales point and I do one from the exit point. And these 2 should give you the same answer right here. Equity created on resale, and it should be the same thing here. And it automatically feeds. That shows it's a proof in our world. That's what we work in. And proof is to make sure you can go down 2 different paths and end up in the same spot. That's what this does for you as well. And that way, you know, because what you're looking for is this is telling you how much equity you created by doing all the things you're supposed to do. And then I actually have a detailed calculation that actually does it for you year by year. This will tell you every single year right here. See here? This gives you the percentage, and this gives you the dollars, cash on cash, which feeds right into this table. Everything is all interactive here. All right.
This is a lot to digest.
This is a lot.
No
I
doubt.
get it. I get it.
No, it's
But
great.
this-
We have a question. Is the
Go ahead.
optimal holding period computation
Yeah.
helping you identify net present value?
Yeah.
It is. Okay.
This is a present, this is all present value calculation. See up here? See the IRR right here? All right. And they're pretty sophisticated formulas in here.
Right.
All right. These are present value calculations, correct?
Levy, you got a question? Unmute yourself.
Yes, I have a question. Thank you for detailed explanation.
You're choppy. You're breaking up.
I know I'm on the phone. It's not good. Okay. My connection.
You're muted.
I'm asking the following question. Try now. This projection before I buy the property, but what happened if I need throughout my realize I need more money? How can I adjust the spreadsheet? Can I play with the spreadsheet?
Well, you can, but here's the deal is that once you're locked in, you got to live with it. Right? What you're saying is you've closed on the property already?
And you know
Yes,
that-
I close on the property, and then what I estimate to be as a repair money, much more than I anticipated.
do another raise.
Well, but this is before you bought the property or
Or
after you
after,
bought the
after.
property?
After.
Oh yeah, you can reload and recalculate this spreadsheet. Yeah, I haven't done it that way. But one of the things that I am going to say is, have these people, Nissan, put property packages together to market?
Not yet. Some of them, yes, not all.
Okay. The reason that these calculations are in there, and I also want to show you here, is where did I put that in here? Well, there's my 7-year my projection, but I'm trying to figure out. I have right here. Again, remember what I told you is the fact that when you do a property package for investors, they don't care about the nitty-gritty detail. They want to take a look at, first of all, sources and uses. Do you have the money to pay? You always do a sources and uses. Sources is where's the money coming from? The uses is they want to know where the money's going to be spent. Some is for property, closing costs, reserves, CapEx, and then for the equity raise. How much has come at the sponsor, the partners, the investors? That's a very important criteria. You got to be open and honest about that kind of stuff. All right. The acquisition loans, if you're going to do a refinance, 1-2 loans, your disposition, in essence, your reversion strategies, your unit mix, your CapEx investment criteria, your growth assumptions in here. And then the most important thing is, what am I going to get out of this thing? Why do I want to invest in this thing? This is a quick snapshot. And again, everything here is linked. You do that input page that I have in there, this whole spread, other than adding that trailing 12-month income statement at the end, all this fully loads itself. All right. Then one of the things that's part of the underwriting is I take what I say is going to be my number in column D. Now I'm going to go through with my criteria is I'm now going to do, this is what I am at acquisition, and this is what the next 7 years are going to be. And then in here, I can go in and I can change any criteria in here and figure out what inflation is going to be, rent roll growth by year. You can change it by year. My bad debts, concessions, management fees, whatever. This is a grid, so you can, what I like it side by side is you can see the assumptions and how it impacts what your numbers are instead of having that in a separate tag. I like putting those together so you can see. And then I come all the way down. And believe it or not, this actually ties to the investor return. And again, when you do it multiple ways and you come up with the same answer, because you want to make sure there's a lot of spreadsheets, that everything's ticking and tying. This ties into this schedule. Where am I?
Investor.
Yeah, right here, this and this schedule. All right, and this schedule. They all tie in, everything all flows, one source of data. But the reason it's broken out this way is the fact that these are going to be schedules you're going to put in your property package.
Right.
That you're going to share with investors. So the question comes down to is, do I want to do the homework now? Or do I want to do it later? I built this so that once you're done and you're negotiating and you get this thing to the finish line and you're ready to go to market, all the data, for the most part, your rent rolls, everything is in here that you're going to need that's going to go into your property package for investors. You're ready to go, ready to go on the deal.
So
All right.
That's all. Doug, I got a question for you. You know,
Yeah.
like with the Michael Blanc and even with the David Lindahl spreadsheets and whatnot, you know, you have the seller's numbers and then you have our numbers, right?
Right,
So a lot
correct.
of times, you know, we see people, they're going, okay, here are the seller's numbers, and then here is the numbers that we're going to project and what we're going to do once we raise the income. But no one understands the process in between day one of takeover and
Yeah.
that process of
Mhm.
getting to your numbers.
Yes.
Right?
Yeah.
They think like
Yeah.
immediately day one,
No,
we're jacking
no.
up all the rents, $100.
That's a
Well,
good question.
that's what the pro forma is. That's what the brokers are
Right.
doing.
Right. And that's why we test that theory. Now, remember, this is no different than buying a business. You are buying a business. What you're doing is you're buying a business and but your revenue is rent, right? That's your revenue stream. And you got to think of that. You're buying a business. So what we have here is I put the year of acquisition is a transitional year. This is your foundation for going forward. This comes right off of this right here. This is at acquisition, what you're going to be able to do, right? And that loads in here. It's going to take you 2 or 3 years. Remember, when you go in there, you have to abide by all the contracts. If you have a 200 unit and you got some people that have a 1-year lease and a 2-year lease and 3-year lease, you're stuck with that all the way through. You may not, it may take you to year 2 or year 3 to realize your full potential when you can control what that revenue stream is going to be. Again, this is why you've got to understand your rent roll. You got to know what your stock. These people have signed contracts.
Usually only a year.
Most of them are a year, but we've seen 2 and 3 year. Like we were involved in a property in Jacksonville, Florida. They had a lot of family members in there below market,
Yeah.
below market. And guess what? They had 3 and 5 year leases. How do you get it? You're stuck with it. So it may take you a time. And again, when you do the reversion calculation and when you do what I'm looking for, my IRR calculation and that type of thing is that, Doug, this is a no-brainer. Walk away from this deal. I mean, first of all, my underwriting criteria, I wouldn't even bother looking at it. I mean, that was a 15-minute discussion. And I see people, I do the rent roll and I see that I'm locked in for 3 years at below market rates. Why do I want to bother with it? Why waste your time? But that's why we go through. And I will tell you, you know, I have basically spent a whole day just analyzing the rent roll. A whole day.
So the
Before
rent
you
roll
even get
is
in.
the rent roll is the key to your profits.
That is correct.
Yep.
That
Really
is.
understanding, analyzing the rent roll. We were looking at a rent roll where it was 2 buildings. One was a 1985 construction full of 1 bedroom, 1 bath, and then the other one was new construction. And in new construction, they didn't have lease start dates and lease end dates. They just had rent. And they didn't tell us when the leases, and they said that these units were occupied. But they didn't have the lease start and lease end dates. So, you know,
That was a new construction?
yeah, a new construction property. So I am 100% in agreement with you where rent roll is where you will find all of your information. The financials are the financials, right? And I always tell everybody here, you're going to inherit the expenses on day one. the expense that you're going to inherit. Because I see a lot of people also going in there and saying, we're going to drop marketing by 50%. We're going to drop, our contract services by 40% in day one. And how do you, where do these ideas come from that you can reduce your expenses so much? If the property is running the way it's running, it's the income, it's the rent roll, it's where you can actually add value is where you're going to make money. Yes, maybe in a month or 2 or 3 after you're settled in, you can renegotiate vendor contracts, push down that, that expense a little bit, really tighten the ship up a little bit more.
Yeah.
But your focus is the rent roll. Your focus is the income, is the money.
Yeah.
What can drive your income?
Yeah. And one thing I want to say that a lot of people don't understand, Dave Lindahl talked about the Holy Trinity. Everybody knows what that is. Your debt service coverage ratio, your cap rate, and cash on cash returns and all that.
That doesn't exist.
But
No, it does not.
it's impossible. But the one thing you have to live by is the debt service coverage ratio.
Yes.
Banks are going to hold you responsible. That is the most important financial criteria when you're negotiating. And when you negotiate and you get a really good mortgage broker with you, that's when the property is stabilized, that you can hit that. They're not going to expect you on year one. When you go in and that's part of what the mortgage brokers do when they do when they're evaluating your underwriting, they're sitting there as how quickly can you get? And I actually show that in my underwriting template. How long does it take me to get to that 1.65? I have that here somewhere. Here it is, down here, right? How long is it going to take me to get to that debt service coverage rate that's going to make me compliant? You got to remember, the first year that you buy the property, you're stabilizing it. You're stuck with the decisions that you bought. You don't start making decisions on improving your property and raising the rents and all of that. Expenses you can control to a certain amount, all right? But the thing you don't control is the rent roll until you start renewing leases. So I would guarantee you almost in every single case, and that's why I call it, my year one isn't year one. My year one is the first year that I have total control over the property. This is the year of acquisition. This is the year of transition. That's
Right.
what this is, right? Then you can take a look at, when you do your underwriting, you take a look at what expenses can we save? What can we do to manage it better? And you start implementing those little strategies in year one and year two and year three. But the most important thing is, okay, when do I control the rent roll? Then you can start running and managing the project. And then you come down here, and this is very important. When am I going to start hitting that debt service? The banks will live with a year, 2 years. Your interest only the first year or two, you're doing some value adds and all that.
Right.
They're going to expect your debt service coverage ratio to be lower, right? They don't expect you to hit it on day one. But damn it, you better make it in what I call your first full year, your second year, or you're going to be in trouble with your bank.
That's why the
That's
assumptions are so
important. That is very, very important. And that's why we measure it this way. All right?
Absolutely. That's awesome. That's great stuff. And I know we had some people that had to drop off. Anybody that's left on the call, do you guys have any questions?
Please.
Yeah, what is an appropriate debt service coverage ratio that you will abide by, Douglas?
Anything north of 1.2. No, I'm going to tell you. I'm going to give
1.2 or 5?
1.2.
1.2. All right.
I'm going to tell you something that you may not know. There are 10 banks in America that can lend under a 1.2. They're the biggest banks in the United States, like Bank of America, Bank of New York, Wells Fargo. They have JP Chase Morgan. They have to go and do an annual stress test by the United States Treasury. Every other bank cannot lend a loan knowing that they're going to be under 1.2. They cannot do it at violation. First of all, every bank in America is insured by the Federal Deposit Insurance Company. That they fall under the U.S. Treasury. They have to follow the rules by the Treasury and the FDIC. I would say that if you can get anything you can get as close to 1.20 in your first year or two operations is phenomenal.
Okay.
Some banks may come at 1.25, 1.3. 1.65, I mean, that is an A property, institutional type property. It's got steady cash flows. You know, there's very little CapEx, very little risk involved in that. I mean, I don't think I've ever seen a C property that ever generated.
No.
Nissan, your experience may be different than mine. I haven't seen one that's got probably north of 1.35, 1.40, to be honest.
Okay.
No.
And the next question, you were mentioning the reversion strategy. How do you go ahead and build that? Do you reverse engineer it?
No, your reversion strategy says, first of all, you do your what's the word? I'm having a brain cramp here. My holding period, and say, okay, I come through here, and my holding period is going to be 5 years, right? So then it's going to load up in here, and again, you see where this is coming from? L5. This is coming
Yeah.
from my input page. I'm gonna go through, I'm gonna go to my input page and say, this property says it's 8 years out. I'm gonna take a look at what my selling expenses are gonna be. It's gonna take a look at my pro forma, where's my equity of creation? I'm trying to figure this out. Where's my equity of creation? Yeah, right here. It's gonna
Yeah,
go
too
through
many
year
tabs.
8, and it's gonna grab that data and it's gonna say, okay, you have an NOI of 1.2 million. You created $2 million because of your profitability, as well as by paying down the debt. And this is the profit you're going to have. And then what's going to happen is it's then going to calculate what your sale proceeds. And I will tell you, most properties that I've been involved with, and I've probably been done about 500 of them. Most of the money that you make for your investors is when you sell the property.
Mhm.
It sounds like to me like, I guess my question is, it sounds like to me like it's reverse engineered.
No,
From
that's
the
just
data sale,
reversion.
the data
Reversion is
resale
no,
to.
no. Reversion is a word that guys in the commercial real estate business say for what's the act, instead of saying exit strategy, what is your reversion strategy? That's all that is.
Okay.
That's all that is. But you know, this calculates what your anticipated closing fees, selling fees, all that's going to be. The gain you got out of from the resale, primarily from increased profitability as well as paying down the debt. You know,
Okay.
in that regard. And I would tell you that as a general rule, this is my feeling. I'm a leveraged guy, but not a highly leveraged guy. Unless I'm doing a value add, I don't like interest only the first year or two, because believe it or not, that 1 or 2 years that you're not paying down principal, that's gonna make your break even point in terms of selling the property. You're gonna push that out to the right.
Oh, okay.
It's not in your best interest. You know, if it's an A property, and here's the difference. An A property is going to be an A property for what, Nissan, 10, 12 years?
That's right.
So you don't have to worry about that. When you're buying a B and C property, how long is that B property going to flip to a C property? You know? So these are the things that you've got to calculate. Now, by pushing your debt out 1, 2, 3 years into something, everybody says, wow, this is great and helps my cash on cash return. What you're doing is you're pushing out what the equity created at reset. These are the things that work against you, for or against you. This is why you have all these calculations in here to figure out, you know, the B property, how long do you think you're going to own it before it flips to a C property and the value is going to go down? The cap, you know, when cap rates go up, the value of the property goes down, right? It's an inverse relationship. And these are the things you got to take into consideration. You know, I don't want to hold this property for 5 years. Well, then the last thing you want to do is have interest only for 2 years.
Right. You're losing on the
Makes sense.
equity creation.
You're losing.
Right.
And that's all the investors care about. What's my cash on cash at the end of 5 years?
Mm-hmm.
So it sounds like to me like, don't do a refi unless you absolutely need to.
Well, no, again, it all depends on the market you're in. You know,
Right, okay.
if you're at a 3% interest rate, well, let me put this, if you're at a 5% interest rate and interest rates drop to 2.5%, man, refi. Absolutely, because
That's true.
what you're going to do is your cash on cash is going to increase tremendously by doing that. Your debt service ratios, all that's going to change. Now, sometimes you want to do a refi because you made a promise to your investors that you're going to give them after 2 years,
Preferred.
you're going to give them a preferred return. One of the ways you can pay for that is knowing that you win at a higher interest rate, you're going to refinance at a lower rate, and you're going to generate equity on the refinance and generate cash flow. And hopefully if you refinance, you get a bigger line or whatever it may be, and you can actually cash it out. That's one of the ways, that's one of the tactics you can use to generate a preferred return, the cash flow you need to do that. So
Right.
it all depends, you know, that there's many things you have, you know, if you're buying a property at 8% interest rate and it drops to 4%, man, I'd say as quick as you can refinance
Yeah,
that,
definitely.
do it. Absolutely.
We have a question.
Interest rates
from
never
Cliff.
vary. I'm
We have
sorry,
a
go ahead.
question from Cliff. He goes, when cap rates are rising, is it better long-term to hold and turn more quickly as cap rates are dropping? And do you have a method of testing that in your optimal holding period computation?
No, I do that a little different calculation. Sorry, guys, to make life complicated. My underwriting template, I actually pro forma sensitivity to my exit price. I try and figure out what the future interest rates and cap rates are going to be based on the NOI that I expect to do.
So you can literally predict whether or not
Yes.
it's good to continue to hold it long term
Correct.
or turn it in a faster fashion.
That is absolutely correct.
Wow.
Absolutely.
Okay. All right. That's what I wanted to
And
know.
you're
That's
always
really
measuring
that's
against your most current T12. And again, this is something that you would keep going forward, because this calculation here is, if you're hitting your numbers, it's always predicated on your exit strategy. When you buy, it's based upon the information you have today. 3 years from now, the world could have changed. You come in here and you recalculate it and you say, wow, you know, the cap rates are up, down, interest rates, the world changes, and you can come in here at any given point in time, rerun this thing, and you can say, wow, you know, at a 10% interest rate, you're dead in the water. But baby, you know, you don't want a cap rate at 10%. And remember one thing, there's an inverse relationship to cap rates and interest.
Right.
Interest goes up, down. And we all know, does everybody know the formula for determining, do you guys know the 3 criteria to determine the price of a property? Anybody-
NOI,
income
cap
and
rate,
expenses.
and purchase
No,
price.
no. There's 3 ways you evaluate a property. And Nizan, you better not answer this. There's 3 ways you determine the value of a property.
Cap rate, sales
comparison?
price, and expenses over or
No.
under income.
No, what you do, first one is replacement value. For insurance purposes, when you insure the property, you want replacement value, right? So one is going to be if you did a knockdown because of a fire or whatever, and you had to rebuild the property, replacement value is one. Number 2, which you use in commercial properties, is called the income method. The income method is you take the most recent trailing 12-month NOI and you divide by the market, not what you calculate, what the market cap rate is that you're in. And so if you have a $100,000 property and your cap rate is 10%, that property is worth $1 million. If your cap rate is 3.2% and you still have that $1 million NOI, your property value is like $8 million. What's important to know when you're determining the property value is the cap rates in your market. And what I hate in some of these properties, they make very little profit, but because the cap rate, Florida is a typical market. Florida has been, Nizan, the hottest market for what, the last 10, 12 years?
Yep.
You do realize that if you get a HUD mortgage or Fannie Mae or Freddie Mac mortgage, Florida is the only state you can get a 75% loan to value. Every other state, you got to go 80%. Because the value is there, because of the amount of volume that happens in there. And the third one is comparable sales, insurance replacement value, and then the income. Those are the 3 ways of property valued. And theoretically, if you get an appraisal and everything all comes together, the 3 should be somewhat aligned. You know, there'll be discrepancies in there, but for the most part, those 3 should be within a certain range. And if you hit that target, you know, you probably paid a good price for the property. But I use this. I actually pro forma what I think is going to happen to interest rates and cap rates, and I come through here and I do the math. And I just hate to say it, guys, but there's a lot of math. What you're buying is a pretty sophisticated process. You're buying a business. And
That's
you
right.
gotta know your numbers.
That's right.
And I hope I didn't overwhelm you guys. I really hope I didn't.
No,
No, I mean,
that's-
I look at this and I'm like, you've created a financial crystal ball for multifamily.
This is my standard model.
I mean, you can literally predict the future with this.
That's the whole idea of it.
Yeah.
Well, why would you else buy the property? And here's the point, guys, in all honesty, right? I have bought businesses, I have sold businesses, multifamilies, the whole 9 yards. There's two types of risk: stupid risk and educated risk. This is an educated guess. There's no science to this thing. I may fall flat on my face because at the end of the day, if you don't execute to the plan, you're not going to get the desired result.
That's right.
That's the key. Anybody can put it on paper, but I'll tell you what the litmus test is, guys. When you buy these properties, is going to be your investors and your bank. Are they happy with what your performance is? You gave them the game plan. You gave them the underwriting. They expect you to deliver on that.
That's right.
That's
That's
scary
right.
when you sign off on that $2, $3, $4, $5 million mortgage.
But your reputation is on the line. too, so-
Absolutely.
Mm-hmm.
And
That's
that's why you need people like the Nissans of the world and Paul Withers of the world, these sponsors. They want someone that's going to sign on the mortgage that knows how to execute. That's the key.
Right. Yep. Got to go
You
with
can
the
build the,
result and execute.
you can build the fanciest spreadsheets in the world, but if you can't execute to that plan, it isn't worth the paper it's written on.
That's right. That's right. Awesome, guys. This has been fantastic. This has been great.
I hope
He does get a little carried away.
I do. I do,
No,
but I
that's
think
good.
this is the perfect model. I mean, like I said, the blank one is kind of okay, but it doesn't give me the detail where I need to see the detail for me.
The Michael Blanc, the David Lindalls, it's good for people who are
Basic.
getting started, who
Mhm.
don't really understand, right? Okay, I can see what my cap rate is, I can see what my cash on, but the process, the journey
Mhm.
is missing in those spreadsheets,
Mhm.
right? The actual thought behind everything. That's what's missing behind it. This is a very, this is a robust but live model. It's alive. It fluctuates. It moves. It ebbs and flows with everything, right? The blanks and the Lindahl models are very stagnant and very static.
Mhm.
Is my numbers is
Yeah,
your numbers,
changing.
okay? But how long will it take me to hit my numbers? What's that process? Where am I going with it? How do I know if I'm going to ever achieve that in the time? And just like you said earlier, what is my timeline to achieve that?
Yes. How do you calculate that? Well, I've done it for you.
Mm-hmm.
You
That's
know,
right.
and remember, the type of mortgage that you want ties into your exit strategy. It ties into your holding period. All that plays in, and I've taken all that into consideration here in this financial model.
That's beautiful.
Can we see where you input the information? Is it like, I just want to see what it looks like.
On spreadsheet,
Assumptions and property.
everything
So
is
this
right
is-
there.
Where you put all the information? So
That's it.
is this,
Are you talking about income statement, the profit and loss and that?
The T12 and the rent roll and everything.
There's two. I'll tell you what, this gives you the inputs that you want. The underwriting template up here. This actually, when you do the rent roll is actually fed into this audit. All this is all fed in automatically from the rent roll. And then in here, this is where you put your numbers. These are
Right.
hard coded. These are your numbers, right? Where you think they are as you play the model.
Based upon the trailing 12 months, what do you think they're going to be?
Correct.
Don't go according to pro forma because that's pie in the sky
But
for the most
But
part.
again, a reputable broker, these would be reasonable. And remember, a number by itself doesn't mean anything. It needs to be compared against something. So at least you have a comparable to go upon. And that's why it's important to know the assumptions that the broker, because remember, what's the broker's job? The broker's job is to get the maximum value for the seller, right?
Yep.
And what's your job? Your job is to buy it as low as you can.
Mm-hmm.
And by understanding the deal, you can negotiate with them in terms of where you see fault in it or whatever. And remember, I don't know if you guys have been involved in the negotiations. I know, Nizan, you have. But when you get into negotiations, normally they take, 50 people, 100 people, whatever, and they take, this is when you got to submit the deal, whatever, and the deadline to do that. Typically, they're going to get 3 to 5 of them. So what happens is it's an iteration. Then what happens is they're going to get 5. And they're going to say, okay, do you want to fine tune your presentation? You made the final cut. You made the cut. Do you want to make any changes? You want to fine tune? Now you start working back and forth. Then if you want to make any changes, you do. If you don't, then you may not get on to the next one. And then the next iteration, they get down to usually 2 or 3, the real serious ones. And they're going to say, okay, now we're down to brass tacks. All right. That's where it's important to know how they got their numbers and how you got our numbers. I have never seen these things go in one iteration. Nizan, what's your experience on that? 2, 3 iterations before you finally get to the dance?
Oh yeah, absolutely.
Yeah, it's not one and done. This is a long-term negotiation that's going to go through. Remember, guys, you're buying a business. It's not like buying a house.
And that's what I always tell you guys, right? When you're putting your offer in and you're talking to the broker, you have to justify to the broker why you came in with that number. This is what we're seeing. This is what our numbers are. This is how we underwrote it. And if we're missing something or you see something differently, share that with us because this is what we're doing, right? That's why you got to go through your numbers and break it down. And even when you're raising capitals, it's not just when you're negotiating with the brokers, but when you're raising capital and your investors are talking to you, you need to be able to go and in investor language, explain to them your underwriting and how you got to these numbers and what your projections are and what you see and so forth, right? That's part of the raising capital part of it as well. Understanding how you got to your numbers so you can explain to your investors, listen, this is what we saw. This is where we're going at. We have a 100-unit property. We're going to turn over these many units in a year. We're going to then stabilize it within another year. We're going to have these many turnovers. These many people are staying. We've calculated this. Hence, this is why we're going to hold it for 5 years, because we're going to take 2 years to stabilize it and renovate, and then 3 years to really hum it and tighten the ship, get those financials in so that we can sell it in year 5, right? So it's part of the negotiations with the broker to get the property. And then when you're raising capital, it's explaining it to your investors. This is why. This is where we're at.
Absolutely. And I just want to enhance that a little bit. That's why I try and get at least 3 years worth of financial statements and tax returns. Right. Because how is this year going to be any different than last year? What did they do differently? And that's where you're looking for the inconsistencies. And, again, a very smart seller is going to start probably 3 years prior to the sale to try and fine tune the business model to drive up that NOI. It all comes down to NOI. It's your job and your responsibility to point out, well, in 2 years you did this, and how come that's not here now, and this and that. This is the horse trading that goes on. You got to flush that up. They're not going to tell you that. You got to find it on your own.
Right. Absolutely. That's
why they call it the due diligence period.
That's why they put 10 heads or 20 heads in the same month of year 2 or year 3.
That's right.
Yeah.
That's why you have to. That's why I always tell you guys, while you're learning and while you're underwriting and talking, go into LoopNet, go into Crexy, pull down financials, 1, 2, 3 years, start reviewing them, start learning what to look for in the financials. So when you're talking to a broker and they send you financials and you're looking back at the history, you can start saying, you know what, in 3 years ago, right, they were doing X, Y, and Z, and then 2 years ago, it dropped down, but now suddenly the renovations went back up, or the NOI popped up, but now they've got a lot of CapEx going on. What is that telling you? What is the story that the property is telling you, that the financials are telling you, right? It's important to really understand that, and just like a stupid example, you see marketing, You see a high number for marketing and the property's at 90% occupancy. And a lot of people will just say, oh, marketing is so high, we'll just drop it down. But what that property is telling you is that this property needs a lot of marketing to maintain that 90% occupancy. So if you drop that marketing down for no reason, guess what? Your occupancy is dropping.
Yeah. And remember when I said that my underwriting criteria, one thing that you guys have to realize, and now the rules have been changed. I haven't looked at multi-property in a couple of years, but you can't close on a Fannie Mae or Freddie Mac mortgage if you're under 85% occupancy.
Right.
And so it's very important that one of the things we look for is month-to-month rents. That's why we spend it the rent rolls, because month-to-month means, hey, they loaded up with a lot of month-to-month just to boost up that occupancy. 3 months from now, they walk out. And remember, you're going to file statements. I don't know if it's going to be quarterly or annually with your bank.
Right.
You got to send them that. All of a sudden, you see your occupancy at 82%. You now violated a covenant of the loan agreement.
That's right.
This is real stuff, guys. And the other thing you don't want to do.
And your income dropped, and you're stressed.
Correct.
And it leads to an unhappy life.
Correct. And I will say this. Karen and I, by trade, and I will say this in all honesty, we are very conservative in our underwriting. And we probably miss a lot of deals because we know where to walk away. And we think it's unrealistic and there's no way that we can make that happen. You've got to find out where that line is with you. Because at the end of the day, when you look at like this table over here in terms of the expenses and everything in there, those are real numbers you got to live by. And that's why I have every single year, because not every year is the same. Some things can change, whatever. And that's why I build my models so that every year stands on its own. You don't know what the future is going to be, but you try and project the best you can. But what you put in here, again, you got to live by it. The key to any deal, the hardest thing to do is get to the finish line. The second hardest thing to do is to execute to the plan.
That's right. Closing, I mean, I always say closing on a property is fairly easy. You got to come up with the money, you give the seller the money, you own the property.
Yep.
But it's executing the business plan to be successful. That's the hard part. Because first of all, you've got to make sure that your business plan is a good plan, is a good model. Then you got to find the right property management company, and then the on-site manager to make sure that they will then go in and execute the model and the plan that you put in front of them. So there's a lot of moving steps, right? Closing on a property is easy. Once you own that property, that's when it is. Cliff also asked, do you have a place where you can add a slush factor for a cushion?
Yeah, if you want, you can put a line anywhere in here, and you can say, miscellaneous expense or whatever it is. I'll tell you what I normally do. All right, what I do is I bury it in other income. That other income is where I kind of play. It doesn't matter where you hide your slush fund, but I think it'd be prudent. But the one thing you want to be careful of, don't lose a deal because you're being too conservative. That's always the hardest line to come
Right.
is, what is that line? Do you want to lose a $5 million deal on $4,000 a month, annualized? But the other thing you got to remember, think about this too, guys. If you miss it by $4,000 a month, that's $48,000 at a 3% cap rate.
That's a lot.
Equal 48,000 divided by a 0.03 cap rate. That's 160. That's $1,600,000 worth of NOI.
Right.
So that cap rate has a huge impact. And you sit there, what's 48,000? 48,000 is $1.6 million of NOI you could either have, or you blew it because you're too high in the expenses.
That's right. That's right. We have a property that we bought where the rents now are $700 below market, below our competitors. So we're just bumping it up at $400 or $430 on a 6 cap, and that raises the value by around $8.5 million.
Yeah, phenomenal. Yep.
And we're still below market.
Yeah. And that's in a great spot to be, to get that property. There's good and bad about low cap rates. When you own the property, it's great having low cap rates because you don't have to drive a lot of profit to get a lot of sales price. When you're trying to buy, you better have a very fine pencil.
Absolutely. Absolutely. Guys, thank you so much. I think we've kept you on long enough. We appreciate your help. I'm gonna keep sending you the weekly invites to these calls. Please
Yeah.
hop on anytime you want. You know, you've got a freestanding invitation to come on, share your
Appreciate
knowledge,
that.
network. I know a lot of people in the group would love to partner and work with you guys if build a
You
connection.
would as well. We're looking
Yeah.
forward to partnering. I mean, we,
Yeah.
we,
Help with the underwriting.
yeah, we can definitely help with the underwriting. And I will
Yeah.
say this, is, Karen is also, if you ever get to the point where you're actually putting the property package together, Karen can help with the SEC. She's done that for a long, long time. Underwriting, and, I know that you guys probably have your sources, but, I have quite a banking background that, I know where to get money.
That's great.
You know, where I'm always struggling is coming up with that rich sponsor that's going to sign off on the mortgage. I don't have that kind of equity.
We kind of lack the investors, the investor base. And that was something that kind of, was hard for us to get the investor base. Not so much the sponsors, they had a couple sponsors, but it was the investors to make the deals.
Well, I know Daniel and Natalie are working on that 16 unit. So I would love it if you guys could take a look at that underwriting.
Yeah.
This gentleman on the call who's been quiet, his name is Gil. He sent me a 240 unit in Augusta, Georgia with the underwriting. I'd like to send that over to you guys as well. We can talk about that. And, I have my Latin group that raises capital for us and whatnot. And they're still, I've gotten them accustomed to multifamily. They like multifamily. Have exited 3 deals with them already. So they're
Okay.
happy.
Well, I would be more than happy. I don't expect people to be experts on this thing. I would relish the opportunity to put my model to test and do the underwriting. Send me the deals and I'll do the underwriting.
Hey Douglas, I did go ahead and send you the one of the properties that we're working on,
16
Okay.
the 16 unit in Hialeah. I sent you the underwriting and
I think we sent it to
Okay.
Arkansas. We're not doing the
we're
Arkansas.
not gonna just let you know, we're not doing the Northwest Arkansas one, because I sent you 2
Okay.
deals.
Okay. And I
So,
also want to
I'll-
tell you one thing. If you call me Douglas, I'm going to get mad.
Okay,
The only
Doug.
person that called me Douglas was my father. And that's when I was in trouble.
Just out of respect.
I go by Doug. Other than
Also,
having
one last question. What kind of business plan would you implement if it's a new build?
I'm sorry, what? Say that again?
What kind of business plan would you implement for a new build? Do you recommend obviously raising rents? Anything else that we can do as far as the business plan for the new build?
Question.
What kind of
It
business
sounds
plan
like
would
you're asking what would be your strategy if you purchased a new building to increase the value? Is that what you're asking?
Yes.
Well, all you can
Well,
do is take a look
depends.
at the
I mean,
value
depends upon, is there some extra room where you can get other income from?
That's
Are
it.
there amenities that you might be able to implement, things of that sort? So,
Okay.
depending upon where it is, what you have, whether you can use it for storage, parking, whatever, that's where you're gonna be using.
Yeah.
You're getting other income
Yeah.
to,
Brand new
increase
construction is difficult. I mean, the only thing you can do is look at the amenities and what you offer. Because at the end of the day, it's a new property.
True.
And all you can really do is just measure to make sure that you're getting fair market values for your rents.
Right. Well, I mean,
Awesome.
the other value add in a new construction is if you're buying it where the developer has occupied it with below market rents.
Yeah.
And then
Yeah.
all you do is push the rents, right? But
Yeah.
you got to make sure that's where you're coming in on. Gil is saying, what a fantastic call. Thank you, Doug. You and your lovely wife rock. Thanks again. So
Okay. Anytime.
Thank you. Thank
Oh,
you,
I
Doug.
hope we
Thank you,
didn't, blow anybody away with that. That was not the intent here, but these are pretty, we take this pretty intensely. I mean, it's serious, but it's great when we've had deals, work for us and we've taken positions where you got a small ownership, by doing the underwriting and all that. We didn't have to put much money or any money into the deals. And, it's worked for us. And I get great pleasure in getting these things to the finish line. I mean,
Yeah.
at the end of the day, you sit there, we finally did it.
Mhm.
Yeah.
That's a
Hey,
good
Dennis,
one.
so we would like to get in a call with you.
Well, I remembered we put for Friday, but I forgot Friday, we're gonna be in
In Boca.
Nizan's event.
Yeah.
So I got.
Oh,
back this
okay, in the
week.
morning,
Yeah, this.
You
10
guys gotta
a.m.?
come down tomorrow. You guys gotta come
Yeah,
down.
so-
tomorrow.
Okay,
Are you coming down tomorrow to for the pre-networking, Daniel, Natalie?
Yeah,
He is.
Okay.
I have to stay with my daughter, so.
Okay.
Yeah.
yeah, we'll be there.
You're gonna go there.
Yeah.
If it's at
Okay,
the
so
bar,
next
at the
Friday.
hotel. I'll be there.
Okay, fair enough.
So he'll be up there.
But yes,
it was a
we'll
real
go ahead and
pleasure,
schedule.
and hopefully we can work together and get some deals done. And at the end of the day, it's all about making money, right?
Yeah,
Yeah.
let's start with this one right here.
Yeah,
With the one in Hialeah.
one thing I do want to say, and I'm very sensitive to this, is when you get into these deals, know who your partners are.
Oh, yes. No, I agree with that.
That is extremely important. And I
That
just
is
want,
extremely
I
important.
told this on this, but I just want to make sure that you guys know, Karen and I have licenses on the line here. We're certified public accountants, okay? Our business is Latin. And FIDES means to be honest and to be truthful. We're not going to give you bullshit.
How about Semper Fidelis?
Yeah, that's true. Forever true, right?
Yeah,
Daniel,
always faithful.
Daniel's a
Always
Marine,
faithful,
and
that's correct,
Natalie's a Navy corpsman, and Daniel's a Marine. So
Good for you.
thank you for your service.
And my
Awesome,
father
guys.
was a Marine in Korea.
Awesome.
Oh,
Yeah.
awesome.
Yeah.
Did,
Her
uh,
father
Greatest
was,
generation.
My
in the
father's
Army in
my
Korea as well.
Yeah.
Anyway, it was a pleasure. We took up a lot of your time. I enjoyed the conversation. And Nissan, I hope we met your expectations.
absolutely, you blew them away. I appreciate you. Thank
That
you.
blew us away.
Thank
Yeah.
you.
Very
Have a good
good.
evening.
Thank you, everybody.
Thank
All right,
you.
we'll be
Take
in
care.
touch. Have a good night.
Yeah.
All right,
Good night.
thank you. Good night.
Good night, guys.